On this episode of Through the Pines, we'll cover the 2026 financial landscape. When it comes to investing, when it comes to AI, interest rates and monetary policy, inflation and tariff impacts, what about geopolitical and policy shifts coming up? We don't know. Global diversification and emerging markets, cryptocurrency and digital assets, private markets and alternatives. What can we expect in 2026? Let's dive in. Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while combing out his glorious locks of fur. This is Through the Pines. We welcome back our financial planners, Rex Baxter and Brandyn Smith of planwithbaxter.com. They are the 2023, 24, 25, and they better be the 26 Forbes Best in State Wealth Management Teams for Utah. They are also the Advisor Hub, fastest growing advisors to watch, under $1 billion, and the receivers of the Ameriprise Client Experience Award. Welcome to the program, Rex and Brandyn. Rex, it's that time of year where we wrap up 2025. We look at the 2026 landscape. What can we expect? Sum it up in one sentence. 2026, go.
A year of change.
Ooh, that's a good answer. That's a good answer. Okay,
thanks for having it.
What a political answer.
Yeah, that's an impossible question. So yeah, Rex, 2026 is upon us, and so we have some things that may be happening. We already have something happening, and that is at least on the policy side of things, and we'll get into that. But anything new on the investing side in 2026 that we should expect?
You know, again, thanks for having us on your podcast.
Yes.
We love being here. You know, I think at this time of year, a lot of people are kind of looking back, and did I achieve my financial goals? Did I achieve my goals I set at the new year? And as they reflect and look back upon that, and they're starting to look forward at what goals do I want to put in place in 2026, I think this is a real opportune time for us to talk about, you know, what are our thoughts and what do we think about looking forward? And we're not going to get into, you know, specific projections on this podcast. Probably on our next podcast, we probably will get into the year ahead on financial projections and where are different people putting capital markets and things like that. But there will be a lot of changes, right? And so one of the common phrases that we hear out there is the only thing of certainty is uncertainty. And so, you know, that's one thing that I think is coming ahead. I do think that, you know, this next year is a midterm election year. And so I think that alone is going to bring some uncertainty to us. I think that as we go in now, we've seen some of the new administration's agenda through tariffs and through kind of the One Big Beautiful Bill Act that got put in place earlier this year. They still have some work to do, I believe, on healthcare. And some of the subsidies that are expiring that are, you know, a lot of people are feeling pain on right now. And so I think there's a lot of his agenda that he still wants to work on, and his administration still want to work on this next year. So,
all right, Brandyn, what about just basic investment techniques? Anything new going into 2026?
Yeah. One thing that's interesting, I've been talking to clients about a lot, is the Consumer Sentiment Index, which is an interesting index that tracks how people are feeling about the economy. Right? It's not like what the market has returned. It's how people feel and what their sentiment is, as the name would suggest. JP Morgan actually has a really interesting piece where they go back and they track that index from 1971 until today. And you know, no surprise, people feel great and then they feel bad, and it's up and down. This chart just it's like, it's common. I've got it up. It's just up, down, up, down, up, down, up, down. What's interesting about it is when you track it over time, the peaks, so that when people are feeling just euphoric about the markets and about their financial future, then what they did is they tracked what happens the next 12 months on the S&P 500. And the average rate of return in the following 12 months was 3.9% rate of return.
Really?
Yeah, when people are just feeling the best about things. Then they track the sentiment troughs. So where people are just like down in the dumps. This is where Rex and I are getting phone calls like, hey, it's going to the bottom, sell right? Like this is crazy. Following 12 months, average rate of return 24.1%.
So sentiment is following what's already happened to the market. The sentiment's behind what the market's doing.
Typically, it's what we refer to as a trailing indicator, and it's also what we refer to as a contrarian indicator.
Yeah.
And so when I grew up in the business when I was younger, you know, we would frequently look at that time I worked for Merrill Lynch, and Merrill Lynch had a great market investment professional that would follow market sentiment very, very closely. And so we would actually use that as a contrarian indicator as far as to kind of guide us whether we're getting more aggressive or more conservative in the portfolios. And I think it still holds true today that is, people, the way you feel about the market is kind of a trailing thing. You're looking at your statement, and if your statement's up, people are typically feeling pretty good about things. And typically that happens during market highs. And when your statement is down significantly, typically you're feeling a little more stressed and a little more concerned about your financial life and where things are at, and am I going to be able to retire on time, all these things. And so, so you have negative sentiment about the future when those things happen. And yet we know fundamentally you should be doing the exact opposite, right? You should be buying when it's low and selling when it's high.
So I agree with all of that. What makes this kind of interesting is the October numbers, right? So October 2025 came in at 53.6. Now, that's a low, like a significant low. That's like a 2008 low. That's like a 2022 low. That's like a 1980 low, right?
So we're poised to go whoosh to the moon, Alice? Or what?
Well, you never know, right? And that's what's fun about markets.
Yeah.
But what's interesting, what we do know is that people feel really, really bad about the economy. And so you would say, well, man, are their portfolios not performing? No, right? If they've been invested correctly, most people have really good returns going into 2026. And so the question is, why on earth do people feel so bad when returns are so good?
I'm going to answer for every person out there. This is why everyone feels so bad. Because in April 2022, the economy fell off a cliff and it never came back. It's just stuck in the mud, spinning its wheels. And people have had money from the COVID and they were kind of doing okay. And then it has just finally been like, enough. We need to see movement on either incomes or prices coming down or something. And it's not happening fast enough in the new administration.
So I think we have to be more specific than that, right? I agree.
I said April 2022. That's pretty specific. Do you have like a time in the afternoon?
But your cause wasn't specific.
Yeah.
Cause wasn't specific.
Sorry about that.
The issue was that we had a lot of inflation in 2022, and that incomes were not keeping pace with the inflation.
Correct.
And so the economy has recovered, the markets have recovered, but our incomes have not fully caught back up
100%.
With inflation, but they've started to.
Yeah.
Again, it's just not quick enough for you. But in addition to the incomes not keeping up with inflation, so people are feeling that financial pressure of not being able to buy the same amount of goods and services as they could 3 years ago. But in addition to that, we just got done with the government shutdown, right? That was shut down during October. We also, because of that, we had uncertainty on employment numbers, and unemployment has creeped up slightly from an extremely historical low number that was in the 3% range up to about 4.2 to 4.4, which is still a very low unemployment number, but it's higher than what it was before. And so people are nervous about that. In addition, we have a number of things going on geopolitically worldwide, whether it's, Ukraine and Russia still going on, whether it's the Middle East, whether we're talking about South America. There's been a lot of activity down around Venezuela, things like that in the area. And then on top of that, we have a lot of healthcare issues in the nation that are expiring this year. And I think all those things starting to combine is what's putting pressure on people's, psyche and their sentiment.
Right.
And so I don't think it is just one thing from 2022.
No, I didn't mean to suggest that at all. But that's when it happened, I believe, and then it just hasn't recovered fast enough, and so people are like, enough already. Like, it's been years. Like, when are we getting over the hump? And so, and then they just blame everything on everybody.
Yeah.
But okay, interesting stuff.
But the problem is people will take their personal, like where they feel what they're feeling, and they'll apply that to their investment portfolio. And they fail to realize that, for better or for worse.
It's not the investment portfolio's fault.
No. But corporate profits look great, right? And that makes people mad, sure. But at the end of the day, when we're trying to be investors, when we've got our investor hat on, we're trying to follow profits. We're trying to find where money is in order to make more money. And so you look at, third quarter earnings is just wrapping up and looks really, really strong.
And
right?
so profits going into 2026, we don't know, but the indicators are
more positive than 2025.
Wow.
And so, we're looking at a slightly better GDP in 2026 than 2025. We're looking at slightly better earnings for companies in 2026 as opposed to 2025. And so the economic landscape is shaping up to look fairly positive as far as the markets go. Not to say that, a lot of people are anticipating a very choppy year, a very, bumpy year with a number of downturns, and who knows what sets those off? Who knows if it happens, right? Nobody can predict that future. But the way that people are looking and projecting out those numbers at the moment are fairly positive.
This is a good sign.
But exactly what Rex is saying, you just never know, right? You can go into a year and just look right? Like consumer sentiment down, that's a good sign, right? Fed cutting rates, that should be a good sign. You've got like growth, GDP and earnings growth, right? That should be a good sign. You can have all the good indicators in the world, and then some weird event happens, and it just all comes crashing.
What are those weird? Black swan. What is that?
Black swan events.
Yeah, black swan.
We call them weird events.
We call them weird. Yeah,
It's a technical term.
yeah. No, because everything could be going great, and then you wake up a September morning, and someone runs some planes into towers, and they're like, "Well, the whole world has just shifted," and it's in an instant. And so you never know, Rex. Right?
Yeah, I mean, there's a lot of things that could be black swan events, and you just never know what it's going to be. There's a lot of talk about all of the multifamily housing that's been built out over the last decade. And there's a lot of multifamily housing that's been built out across the country. We're still underbuilt as a nation in single family homes, but because we built so much multifamily housing, if interest rates come down, does that facilitate more people moving into single family homes? Then you have all these, apartment complexes that are vacant and dormant and empty, and that hurts the commercial market, which then spirals into construction, which then spirals into families, and it kind of all rolls that direction. Anything could set that off, and who knows what that is. And that's why you want to remain diversified. You want to make sure that, during these market highs are a great time to double check your portfolio and make sure that you're not taking on more risk today than what you're aware of. Because a lot of times you get risk creep, which is essentially you're at a certain risk level a year ago. Now the stock market has done extremely well, and you have more exposure to the stock market than what you anticipated a year ago, which means you're taking on more risk than what truly you're comfortable being.
Well, I will say this time last year in 2024, December 2024, I did not use AI to help me with my notes. And this year I did. And I've been using AI to help me with my notes for months. And so it's creeping into our daily lives, whether we want it to or not. And it's helpful. And as we learn how to use it in a positive way, we end up adopting it into what we do on the daily. And so what happened in 2025, Brandyn, with AI in the financial industry? How did it creep into the financial industry? How are you guys using it in 2025? And then what can we expect moving forward into the next year?
Yeah, we'll see, right? But we have started using approved AI tools, and they vet, and it's interesting, right? Because anytime you're trying to stay on the cutting edge, there's a lot of almost experimentation that's going on, and so you got to really check yourself. And AI is an amazing tool, but then sometimes it's wrong, and
a lot of times.
Yeah. And so you got to make sure you're checking sources. But it's helped with a lot of things, and for me personally, I'm more excited about the future of it, where you can essentially do the work and have AI double check things, right? And look through it and find opportunities and say, oh, what have you considered this, right? And things like that. And so we'll see, right? It is making things more efficient. But I don't know. We'll see.
Yeah, I'm excited for the AI future as well. It's interesting that, just this morning, there was an article that came out from one of our regulators, FINRA, right, that came out and said, last year in 2024, they came out and said, oh, we've got this emerging technology of artificial intelligence that we're just kind of watching that's going to be emerging over the future.
Well, a lot changes in a year.
And this year, they've got, roughly 1/6 of a big portion of their entire oversight is dedicated towards AI and making sure that the tools, the input, the output is all overseen, regulated, documented as part of our regular processes from regulators, and that's how big of a toll that's taking in kind of our lives from a regulatory standpoint. So it's interesting. I was using it last night, right? Looking at some healthcare questions that I had, and I was running it past different AI bots, whether it's Grok or ChatGPT or Copilot, or there's a bunch of them out there, and it was interesting how many times they would spit out information, but it wasn't taking into account that like the government subsidies for healthcare are running out, and so it was still calculating in premiums based upon the government subsidies still being in place, which is not going to be the case as of right now for 2026. Now, the government still has this week to go in and reevaluate or make changes to that, so it still could change for 2026. But as of right now, they're not in place to continue, and AI is kicking it out as if it is going to continue. And so it's one of those things where you need to trust but verify really deeply and not just blindly trust.
Yeah. Huh. Interesting. Okay. Very good. What about interest rates moving forward and monetary policy? We can't predict this, but whatever interest rates, they do this last year, and so will it trend into 2026?
Yeah, I mean, a lot of people are predicting, at least one more interest rate cut in 2026.
So they started coming down in 25.
Yeah, and we've seen a few cuts, and it's interesting because even the Fed, right, they don't know what they're going to do in 2026, right? And they've been very vocal about that, right? We're gonna watch the numbers, we're gonna see where inflation's at, we're gonna see where employment's at, and we're gonna adjust accordingly. And so I tell people all the time, right? Like even if we had every piece of data out there on all these companies, and we had the best team of analytics just watching, which we essentially have both of those, right? We still can't predict future events. And it's the future events that shape and change, right? Because it's funny, sometimes I'll get a call from a client and they're like, hey, we're going into like Christmas season. I want to buy a bunch of like a retailer stock because their earnings are going to go up. And I have to explain, like, yes, their earnings go up, but all other investors are anticipating that, right? And so their earnings need to not only go up, they need to go up by more than we're anticipating, right? You can literally have your earnings go up and still see the stock fall because they went up, but not up by as much as everyone else anticipated.
Oh yeah, no, it happens all the time.
Right, and so with that in mind, you have to understand that like everything is relevant.
It happens all the time. I'll see the earnings come in and they beat estimates and the stock drops.
Yeah,
because they didn't beat by enough or whatever.
Right.
So
correct.
Okay.
Yep.
Yeah.
Or they warned on the next quarter it might not be as good as what people.
I like that one too. Yeah, they're like, "Yep, we killed it, but this happened, so next quarter," and then like the stock tanks. You're like, "Oh my gosh, what's going on?"
I think next year's monetary policy is going to be really interesting. Right?
They'll miss sometimes too, but it'll go up because they missed, but they're spending all this money on this other thing that's going to make money in the future, and so the stock. So yeah, it's really hard to.
And again, you can't predict that, right?
Totally.
Because they have to keep things fairly close to the vest as far as what's going on inside of the company. And they have to be careful about making financial projections and predictions and things like that because, they can be sued for certain things. And so they have to be really, really careful. But I think as far as interest rates, right, I think the predominant viewpoint is that we get 1 to 2 rate cuts for next year is where the current thinking is. But we also will have a new Fed chair next year.
That's right.
Yeah.
Right. And so there's a lot of discussion about who is that going to be, and there's concern from half the country of is it going to be somebody that's going to be controlled and somebody that's going to be influenced by the current administration, and then you have the other half of the country that's not as concerned about that and is thinking, oh yes, we're going to have lower interest rates and they're going to be more accurate data dependent than the past administration, where maybe the data, in their opinion, had been manipulated, right, to cause a certain storyline.
Are you talking politics?
So,
Rex?
I try not to talk politics. I try to avoid politics.
This morning I heard this argument. It was from the cow guy, which most people probably know who I'm talking about. The cow guy, the investor. Do you know?
Yeah.
Okay. Scott.
Scott something.
Yeah. Anyway, but his question that was posed to him was, can we expect an interest rate cut here coming up before the end of the year or the next one?
So we just had one a week ago.
Yeah.
Right.
Okay.
So it depends on when.
So the next one, because the unemployment rate went up, ticked up more than expected, right? And his answer was this. It was like, well, with AI and machines taking over more and more jobs, I think the new normal on the unemployment rate will be higher. So I don't know if that necessarily means a rate cut. So they're all just guessing.
Well, so, I mean, the Fed kind of has a dual mandate, right? Well, between, maintaining inflation and maintaining unemployment, right? On certain levels. And so if you all of a sudden you see the unemployment spiking up, then their tendency is to have a bias towards reducing rates to encourage more economic activity, to create more jobs. And so, so it's interesting to hear that line of thinking. I'm not sure that I'm in the camp that the AI is going to create a lot more unemployment. I think it creates different employment and different employment opportunities. I think that there's still a lot of work that needs to be done on the technology side and in those kinds of fields. I think it's going to increase in data center, in the technology that goes into that we need to be able to create in order to store the data and compute the data. I think that creates more servicing needs in that technology field. I think in our field, it's creating more activity in regulatory issues, right? We have to have additional compliance people focused on AI. And so I'm not sure I buy the argument that AI in a silo is going to create higher unemployment. Maybe it does, maybe it doesn't. Yeah. I don't know.
Brandon, anything on that?
Yeah, it's all unknown, right? And it just everyone wants to see the future, and you just can't, And so what's funny from an investment portfolio standpoint, like bring this back into investing, is the answer always comes down to the same. We'll probably say it multiple times this podcast. You need a portfolio that's well balanced and able to ride through the various market cycles, right? And no matter and how do you build that? Well, you calculate and figure out, what is my future distribution need? When do I need the money? How much do I need? And how do I set that amount aside, right? So that it's not as volatile as the other things, and accept that you just can't predict the future, right? Yeah. You can't predict, and because you can't, can we watch for trends and kind of adjust minorly? Yeah, of course, and try and get better returns. Yeah, but you can't predict the future, and so we need to make sure that we're always prepared for that in wherever the market goes.
Yeah. Okay. So that answers all the rest of the questions. Thanks very much.
Yeah, you bet.
Great podcast.
That's why I said we'll just keep mentioning that.
Because so next up, for instance, would be like, how do we deal with inflation and the tariff impacts? Like, so there will be people who spend a lot of time concerned and worrying about inflation in 2026 and the tariff impacts in 2026. But the answer is just what you said, Brandon, is like, well, just make sure your portfolio is like, how do you plan, I don't want to say de-risk, but how do you plan for that in your portfolios, Rex?
Well, I think stay diversified, right?
Yeah.
Is the answer to that, is you don't know. And I think the most dangerous thing is saying that you do know and saying that it's different this time. And it's not different anytime, right? It's always those same patterns. And so I think you have to be really, really careful with those things.
As far as inflation and tariffs go, I think you have to get back to wondering, like, what is the long-term ramification, right? Is our anticipation that companies just stop making money, right? Like does Apple stop making iPhones? Does Ford stop making trucks, right? The thing about tariffs is it shifts things around, right? And there's going to be winners and there's going to be losers. But we've got, and there's going to be market cycles, right? There's going to be lulls, there's going to be booms, right? And so we've got to build a portfolio that is diversified enough so that we're not making bets on who's going to win, who's going to lose. Because when you get too centered on a bet, what happens, or if you take your portfolio and you get too involved in one section of the economy, something's going to happen. You're either going to do a lot better than everybody else, or you're going to do a lot worse than everybody else. And most people, as they're investing and as they've started to really accumulate and amass wealth, the objective isn't to try and like triple everybody's everybody else's returns. The objective is to safely and consistently grow your money over time. And so when we start looking at tariffs, when we start looking at changes in policy and things like this, I think it's important to stay in a good mind space to roll it back and say, all right, are companies still going to be profitable? Because that's number one, right? Is following company profits. If the answer is yes, and they should be, right? I mean, what does it take for Walmart to close its doors and say we're not selling anything anymore? And Amazon's like, you know what, we're not delivering packages anymore. And you know, all these major companies, could that happen? Yeah, that could happen, but that's kind of apocalyptic, right? And in that case, does it really matter where you put your money, right? Like we're likely in a very, very rough world if that's the case. And so, you know, assuming that that's not going to be the case, that companies are still going to be serving individuals, then we look at it and say, all right, how do we build a portfolio that's well diversified that can kind of ride these ebbs and flows, even though we can't perfectly predict them?
Yeah. Okay. Rex, anything on that? I do know that we do have some fun things going on in policy in 2026. We've got a bill that was previously passed, a big, beautiful bill. So things will change financially for some people on the policy side of things. Tips not being taxed, for example. The Trump accounts coming in. And we don't know what's going on with tariffs. So how do you plan on what do you do about that as a financial planner?
Well, I think there's a lot of financial changes that are coming on that are through that bill, right? And so
no tax on overtime.
Yeah, no tax on overtime, no tax on tips. And
I remember the first time I got my
that.
overtime check, and I'm like, they took so much money out.
Yeah, they take a big piece out of that.
Yeah, that's a big deal
historically, and so that is a big deal. In addition to that, if you're in a certain age group, you get an extra, $3,000 per person in a tax credit. To the thought process on that was to help offset taxes on Social Security, and so there's I think that it will be interesting, but the projection is that come tax time this year, between February and April, that a lot of people in that lower income and lower middle income categories will get a boost, and will have a little bit of a financial boost during that time period. And it'll be interesting to see how they use that. Do they pay down debt? Do they go shopping? Do they invest it? What do they do, with those couple thousand dollars everything, that they may get?
Yeah.
I will say though, right, you hear these like no tax on Social Security, no tax on tips, no tax on overtime. As you really dive into the actual what is written, it's a lot less, like it'll be helpful, right? It'll help people, but it's not as amazing as it sounds, right? For example, no tax on overtime. That's not like every hour of overtime you work isn't taxed. No, the like time and like the small portion of it isn't an extra tax, right? Like it's actually it's
still tax, just normal tax.
Well, and it's a slight discount, but I was just, as I was reading, I was like, this is not as impressive as it sounds. The no tax on Social Security, right? That's not actually true. It's not no tax on Social Security. It's you get that extra standard deduction if you're in an age bracket per person, right? Which helps.
Yeah, my understanding, again, we're not tax professionals, right?
Sure.
But my understanding on the no tax on overtime is you still have your payroll taxes. So you still have, your 6% on Social Security and your 1.7 on your Medicare tax. And then you don't have federal taxes, but then depending upon what state you live in, you'll still have state income taxes on that overtime. And so it does save you from the federal tax, which if you're, for most people that are in that category, you're talking about a 12% savings or a 22% savings on that overtime money. So if you, over the course of the year, if you make an extra, $10,000 for the sake of easy numbers from overtime pay, right, that may save you $1,200 in taxes. And that is helpful for sure. I don't know that is life-changing for you. Depends on your income, but it certainly is helpful. And it certainly can help take the edge off certain areas of life.
Yeah.
And a lot of these have income phase outs, right? And so if you make it over a certain amount, then that goes away and
you don't count.
Right. Yeah.
Yeah. Brandyn, you have some more numbers?
I do. Yeah.
Right. This is a good one. I can feel it.
It is. How did you know?
I'm excited.
This is from Zillow. And according to their Zestimate, right, which is essentially what they're,
is it me? Why do I hate when people make up words like the Zestimate? Give me a break. Okay, anyway.
According to them, 53% of homes in the U.S. have declined in value over the past year. which means 47% have actually increased in value, right? But that's
Are they coming down from an enormous high though?
yeah. But what's interesting, right, is for years and years and years,
Sellers are
like,
dropping prices.
real estate's crazy, but you actually have the majority of homes over the last year that have actually declined in value, and that's up from just 14% a year ago. And so that marks actually the highest level since 2012.
Yeah, so your $250,000 house jumped to $500,000 within the last 5 years.
Yep.
Now it's down to
Now
$485,000.
it's coming down a little bit. Sure.
Yeah. Okay.
Yeah, we had such a big jump when we peaked out in 2021 that it's, people are using that as the new baseline value of their home. As my home was worth X in 2021, and now it's only worth Y. And so it is interesting. I mean, we definitely are not anywhere near the hot real estate market that we were at in 2020 and 2021. You can see that by days on market. I know in one of the counties in the state, it's 76 days on market today, right now for the month of November. And yet a year ago, the month of November, we were at about, instead of 76 days, we were at about 65 days. And so they're actually staying on market a little bit longer, an extra week, not a huge change, but still negative. But the price in that county went from an average home price of $505,000 to $535,000 year over year for the month of November. So prices had actually come up in that county over the course of the last year. And so I think it's very county specific, and you need to look at your own market. But it does feel like we're about to turn that corner with rates coming down a little bit. There's a lot of excitement around kind of the real estate market starting to
shout out to our realtor friends who made it through this last 4 years.
Absolutely. It's been a rough grind since 2022.
Okay, Rex, what do you want to talk about? We've got going into 2026 cryptocurrency, digital assets. Are we...
Can I please?
I know. It's your favorite. Private markets and alternatives, labor market and consumer resilience, or cybersecurity, fraud, the regulation side of things?
I'm curious if cryptocurrency is going to get regulated in 2026 or not.
So there's no regulation on crypto?
And so not really. I mean, there's surrounding regulation, meaning that as crypto comes into the financial markets with exchange trade funds and different things like that, the exchange trade funds have their regulation, things along those lines. But there's really not a lot of regulation around cryptocurrency yet. And so it'll be interesting to see. I know the government has talked about creating their own digital currency to compete with it. We'll see if anything like that gains steam during 2026. We'll see if cryptocurrency, where we've gone from, I think at one point we had almost 11,000 different cryptocurrencies that's insane out there.
I got an alert from my Coinbase account. It said such and such account is down 14% to 0.000. There were so many zeros. Like it had moved a fraction of a penny or something. It's insane because there's so many of those out there.
Yeah, there's a lot of them, and so it'll be interesting to see what happens along those lines. Cryptocurrency at this point in time is taken a downturn over the last few months. And so it'll be interesting to see if that recoups or if it continues that trend. And I just don't know. It's interesting because people have started talking about should cryptocurrency have a place in a person's portfolio. And right now, because it's not regulated federally, we're still prohibited and by firm and by our regulators from putting that into portfolios and recommending that yet until it becomes regulated. And so, it's kind of immaterial whether we believe it should be or shouldn't be a part of a person's portfolio at this point in time. So it'll be interesting.
But is that the same question as should your collectibles be a part of your portfolio or where does you know what I mean? Is it just a different asset that sure you can make it a portfolio, but it's just not a necessity?
Yeah, I think there's a difference because I think that, collectibles, it's interesting. I saw a chart a while back and every now and then it resurfaces and it has a lot of different kinds of alternative investments, right? It has collectibles, it has art, it has vehicles, collectible vehicles, it has collectible jewelry.
Let's go.
And kind of long-term rates of return of all of those assets against the U.S. markets and things like that.
Oh, interesting.
But most of those are physical asset, right? Yeah. You've got a painting to sell. Mm-hmm. You have a Rolex watch to sell. There's something backing that asset. In cryptocurrency, there's nothing backing it, right? It's literally just supply and demand is all it is. There's nothing. Gold, you have the precious metal that's used in a lot of different types of products that you can utilize that has an intrinsic value to it. And so I don't think it is the same. I think it is different because there's not anything physically backing it.
Okay. Brandon?
Well, and it's just not generating revenue. Like, people discount and don't understand that about the stock market.
That's true. That's a big one.
It's huge, right? And not only is it not generating revenue, like a company that's just like generating revenue, it's not growing the rate at which it's, right? Like, companies are not only generating revenue, but they're growing the rate at which they're generating revenue. And so you might buy a stock today and have, a 1% dividend. But if you hold on, it just is another way to think of it, right? You hold on to that stock at that price that you bought it for. Yes, the value of the stock goes up, but effectively your dividend rate will essentially, as that price goes up, right, the rate of dividend relative to the initial investment goes up as well, right? And so you're essentially, and that might be an abstract way to look at the stock market because most people don't look at it that way, but effectively you're buying something that has revenue that is going to continue to grow that revenue into the future and likely into perpetuity. And that's something that, like, a block of gold doesn't do. When you buy a block of gold, the hope is that for some reason, 20 years from now, people will want that block of gold more than they want it today. And is that a good bet? Maybe, and sure played out well last year or in 2025. But we'll see, right? But what I feel comfortable and confident in is that people will want money, U.S. dollars, or the future equivalent of U.S. dollars, right? If that ever changes, companies provide that. Why? Because they provide a value and a service for individuals that they want, right? And so ultimately companies create value, and value is wanted and desired. And if you own a company or part of a company that's creating value, that usually puts you in a really good place.
It does concern me. I'm not worried necessarily about 2026, but you talked earlier about black swan events and different things like that can cause that. And because you have so many different cryptocurrencies out there, it does concern me that if all of a sudden that trendy trend. Do you like that?
Let's go.
That trendy trend.
Well,
that was good.
Another technical term.
I'm going to clock it.
If you lose the supply and demand on that, and you lose the enthusiasm for that in the general public, and all of a sudden you don't have the demand for it, then what happens? There's so much money invested right now in cryptocurrencies and in exchange traded funds that could be a major devastation to the overall economy if all of a sudden everybody that has that invested, it just goes away.
Yeah, that's a problem.
And that would be an issue.
Maybe let me play the contrarian on that.
Please.
You have a lot of capital tied up in assets that are fully digital, right? Completely fiat, right? There's nothing behind it. There's nothing backing it. We have a lot of capital being flown is literally being put into that. If the excitement for that goes away and those crash, where is the money going to go, right? Some people are going to lose a lot of money. A lot of other people are going to harvest those gains and pull those out before the other people lose the money. Where do all those gains go?
Yeah, the gains would come back into the economy.
But the problem is you can't really pay for things with crypto right now necessarily. Like, people are taking money out, I guess. They're selling it and then using that money to buy stuff. But
it depends, right? There's a local dealership that will take crypto as currency to buy a car. And so they'll, you just transfer from your crypto account to his crypto account and you've got the title to the car. So I think there are certain companies that are doing that more and more as it's becoming a little bit more mainstream, but I don't think it's mainstream yet at all.
Okay. Well, as we close out here, Brandon, what are your thoughts on 2026 as far as the financial markets, alternatives, anything you want to add?
Yeah, I think there's a lot of really positive indicators going into it. But with that said, we never know the future, right? And so building a portfolio and keeping a level head. And how do you do that? You go through a financial plan and you figure out, all right, where am I at? What risk can I take? Can I stomach the ups and downs of the market? And how much can I stomach, right? And even if you say, yeah, I'm a long ways out from retirement, or I've got 10 years, 15 years out before I retire, I can handle ups and downs. Let's still make sure we're diversified, right? And that doesn't just mean buying the S&P 500, right? That means looking through and looking and making sure that we're balanced across all different industries, different sectors of the economy, different geographic areas, right? Our large companies, our mids, our smalls. We really want to make sure that we're well diversified. But then with that said, buying assets and companies that are providing and growing in value. And I think if you do that, it provides you a much higher probability of success, right? That you can get through market cycles with confidence. And I think that ultimately, whether we're going into 2026 or 2030 or 2045, I think that's always going to be the answer.
Rex?
I would echo that as far as staying diversified. I think that's really important this next year. I think there's a number of things that are going to be transitionary in nature, whether it's the Fed and the Fed policy and a new Fed president, whether it's a midterm election year that's going to happen, whether it's a number of the changes from the One Big Beautiful Bill Act. I think it's a transitionary year. And any time you have uncertainty, the market doesn't like uncertainty. It doesn't like the unknown. Mm-hmm. And there's some big unknowns on this next year. And that's not even getting into the geopolitical events with foreign wars and foreign conflicts and things like that. And so anytime you have that typically is going to increase the volatility of the market. And yet most of the time in issues like this, they're fairly short-lived, typically, to where those swings, the downswings and upswings are, typically, they're untimable. You don't know how long they're going to last, but generally they don't last very long. And so if you stay diversified and you kind of ride through those things, typically that's going to be the best solution for most people.
Do you guys have, like they do in sports, like who's going to win certain games? Like, do you have like what the Dow's going to hit in 2026 and what the Nasdaq's going to hit in 2026?
Oh yeah, economists love playing that game, and it's even more fun to watch them revise after even like 3 months. Like, well, actually, like they're always predicting and revising.
Yeah, at Ameriprise, we have one of the most consistently accurate economists in the industry, in Russell Price. And so, he's been more consistent, more accurate than most other economists across the nation for well over a decade now.
When does he send out his letter for next year?
And so it should be coming out any time. I don't think it's come out yet, but it should be coming out any time as far as his projections for the next year.
Okay.
But so almost every firm will have an economist, and they'll have their predictions and their market outlooks. And all of those typically are coming out from about the beginning of December through about the middle of January, typically. So they're coming out during this time. And then normally they all will revise that multiple times throughout the year so they can zero in on their accuracy as the year goes on.
That's not fair.
So,
oh, okay.
Yeah,
well, that's good. Well, thanks so much. It's been a great year with you two. I just want to say thanks to you two. I'm grateful to have you on the podcast in 2025. Looking forward to a good, fun, and informative 2026. Hopefully, like exciting, but not too exciting. We got to keep that under.
We agree.
Everything in moderation.
Everything in moderation.
Including your excitement.
Right. This podcast was produced by the Brandyn Collective and recorded in our camp trailer right here inside the Monarch building. If you found value in this podcast, which I know you did, consider supporting us at buymeacoffee.com/Brandyn Media. Just transfer your life savings over to me. That's from me, Brandyn Media, not our advisors. Watch and subscribe to us on YouTube at Through the Pines, where you can see our wonderful, beautiful faces. And like our Facebook page, Pines Podcast. Follow us on Instagram at also Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.